SEBI has come out with draft norms for startups to list in the NSE and the BSE. The norms are very simple. If you have not more than 25% after listing, after the dilution, the disclosure norms come down tremendously. The lock-in for issuing investors is just 1 year. And if you sell after 1 year, it is tax-free because you are listed. You need a minimum of 50 investors for listing. That is to raise capital from 50 investors and 10 lakh per investor because it's an institutional market. You can also go to the main boards if you want, where you follow the normal norms of lock-in. You can go to retail and all the thing. There's an alternate given to you. And if you're loss making, you can still go list, provided you're raising more than, let's say, 80-100 crores. The norms are very simple and very easy to do. So my advice is, those people who want to raise capital in India and who want to go to the public markets is to list in this particular category within the main boards. It is in BSE and NSE. So settlement and everything else is the same. And you can access capital. And how to access capital and valuation depends upon what you sell. It's like a normal IPO. What do you do in IPO? In IPO, you prepare a pitch book. You get a banker. The banker creates a valuation. You agree to that. Then you go meet investors and you sell. The same process you follow. So it's a very simple process and very fast process. SEBI is waiting for people to come, and I would urge people who have a big business in India and who want to list in India. Now, if you have a business in India and you go list on the NASDAQ, it's fine. You could get investors, but you'll not be able to build a brand in India. For example, if you're listed in India, you're quoted every day on the exchange. They'll be trading in your stock. Every quarter when you release the results, CNBC and BTV or whoever it is will call you, and you can go there and explain about your results. When they have panel discussion, they will come and see. People will see your trading every single day. So I think it's good to list in India if you have business in India. And the norms are very simple. You see, right now what is hot is AI, ML companies, because AI and ML has become a global trend. So the startups, I think it will be a wonderful area for people with real deep technology to come, because everybody says that automation is going to increase, and with digitization, AI and ML will succeed. And there are already a lot of startups. The first startup fund, Pi Ventures, has come. I think that's also come in India. And I would say for those of people who have been there for a few years, look at how you can scale up in a very sustained manner, respect capital, and make sure that you succeed. According to me, there are 3 different kinds of, let's say, startups. The first are the companies which are network companies, algorithmic companies like a Google, or SaaS companies. These are companies which get a lot of people on the platform, either B2C or B2B. And when they scale up, they learn how to monetize. They're very rare and very few. Now Snapchat has gone to the markets, and Facebook went to the market. So Google is there, but they come very rarely and they make big IPOs. The second kind of companies are companies which sell technology, like a security technology or a technology for CRM or something like that. And these are companies which sell B2B and have a long sales cycle. So creating the product out of India is not difficult today because there are skills and domain. But selling it is important, and for selling it, you must look at the US and Indian markets totally, and that is a different business, and you have to put more money into marketing and have long cycles. The third, which the great majority of companies in the country and startup, are businesses where the front end is technology. To give an idea, Reliance Retail has got a shop, it's got inventory, it's got display, and it's got supply chain, it's got all the finance and everything else, and the back end is technology. But you got to go to a shop. A Flipkart will have all items on the web. There'll be millions of items. You can go and choose, and they'll be stored somewhere, but you can go and choose, you can do display, you can have a sale. So they get a national market or the international market, but behind it, everything is the same like Reliance. Now between Reliance, which is growing in organic manner, and the Flipkart, which is growing exponentially or whatever it is, both are businesses. So the difference between the businesses is you can put in X amount of money, right? But the money has to be justified by what you get. And what you get could be faster growth, could be greater value creation. But at the end of the day, if you don't run it as a business, then you'll have challenges. And when you run it as a business, you have to be viable and earn, not unit economics, real value that you have to earn to make sure that you don't require dollars of capital to come. Because all this, all this area of saying the winners take all doesn't work. For the winners to take all, you must succeed and must stay there for a long time. Amazon took a lot of time to succeed in e-commerce. They only got $120 billion revenue. They make money to AWS. And AWS is giving them, still making losses there, but they got a great product, they got fantastic supply chain, they're able to scale up, they're able to do well. Now, a Walmart, which still makes $12 billion, is coming and building the back end. I think they got $40 or $60 billion as against $120 billion of Amazon. So, you have to find out and you have to sustain it and do it, because there's no unlimited amount of money to go on funding you. Correct? You've got to start generating. And when you are doing this business, you can spend 10-12% of revenues on technology, on building up and marketing. What you spend on marketing should give you faster growth than what you would get if you don't do that. All right? But at the end of the day, you got to come to a point when it becomes viable. And this is a very important thing, because it's a business. So we have a very simple classification. We put them into 3 buckets, or maybe another 1 bucket. And then another 1 bucket is where they create great IP. But the IP has great value, like a research company, right. Not a B2B company, like a research company. And we see how the figures fan out and we invest. And I think so far we've been fairly successful.
Got it.
Out of 180 companies that we invested, I would reckon about 45-50 are done up rounds. Okay. Out of 180 companies, maybe so far in the last 3 years, maybe 10 have gone bust. It's a smaller number than what you would get. Some more will go bust. It's okay. But our philosophy is, be very careful when you do it. Mentor them, give them all the help, use your networks. I mentor 40-50 companies. I talk to a few companies. I review with them every month and spend a lot of time, connect them to a lot of people. So I think unless the VC puts a lot of input into companies, the companies themselves will find it difficult, because they're in a very competitive ecosystem, right? And all the people, most of the people who start this are younger people, right. Who never build businesses. Right. They don't have the skills of marketing. They're all good techies. It's a great majority of techies, not business people. But life is business. You got to sell. Unless you are a deep technology company where the technology itself is so valuable that you create value. When you start an enterprise as a startup entrepreneur, the most important thing is to make sure that a large part of the value you create, you get it for yourself. You're starting off, you're making the risk. That means you shouldn't have too much of dilution. Okay? Second, it's much better to bootstrap and to create value rather than get money and blow up and then you're not able to raise money. Third, you have to decide whether you want to spend more time raising capital or more time on the business. The business requires you, because once you create value, capital will come. But for that, you got to be frugal. Fourth, you got to create sustainable value. Sustainable value means you create a brand, you create great technology, you create customer experience, customer delight, and you make yourself so valuable that more and more people come, whether it's B2B or B2C, people come. And lastly, you must get a set of investors who give you capital and support you all the time. Okay? And if you sign agreements where there are too many conditions, at the end of 5 years, 7 years, when you do well, you may not get much. Because every investor who comes in gets first priority for liquidation, first priority on sale, and they have multiple layers. So if you have multiple layers of financing and create a very complex capital structure, you are the one who's going to lose, because you are the last in terms of priority. So my advice is, look at your aims, see what you want to be, grow at a pace that you can handle. The world is big enough. It's not necessary that winners takes all in all areas, and it's not happened so far in the world. And if go on adding value, create a sustainable business plan, and make sure you have a large stake. I think Less Venture is part of the capital or venture capital or startup ecosystem that is being created in India. It's a fantastic experiment, because what Less Venture does is to create a connection between two sides of the equation. The investors who want good companies to invest in, and there are companies which want to raise capital who are startups, right? So on one side you have, I think, 12,000 companies, other side 2,500 companies, and in between you bring them together and you add value, because you're able to curate them, you're able to talk to them, you're able to make sure that they pitch well, and you're able to put a shorter list than otherwise to come, and you're able to give a platform for both people to talk to each other. And by getting in some people, extraordinary people who are prime investors, to come and stand up for them and say, I've invested, because you need 1 or 2 prime investors for every company to help them, to mentor. You are essentially creating a value addition in terms of people who come and work with the startups. So I think the fantastic thing, I'm very happy the way Less Venture has done. And events like this, where you bring people together, you discuss, you educate people about developments in the marketplace and what has to be done about strategy. You show before them companies who have been very successful, and you will try to learn what made them successful. Because in the large ecosystem of startups, I'm told there's about 28,000 startups today. Not everybody is going to succeed, right? So if you have a reasonably large number of people who have been successful, and a few of them who have been extraordinarily successful, I think you must consider your job done. It's a portfolio allocation strategy, and by your thing, you are enriching the portfolio and allowing investors to invest in a curated portfolio, which hopefully over a period of time will have a greater value addition than a raw portfolio.